Most people are misreading XRP right now. At today's crypto market size, $100 XRP looks mathematically extreme. But that changes if the digital asset market expands into the tens of trillions. In the next few minutes, we'll break down the exact market cap math, XRP supply dynamics, institutional capital, tokenization, and the conditions that could make a $100 valuation mathematically possible. At today's crypto market size, a $100 XRP would require roughly a 6 trillion market capitalization, depending on circulating supply. That immediately raises the obvious question: where would that valuation come from? Because if the entire crypto market remains about a few $1 trillion, the math becomes extremely difficult. But crypto doesn't exist in isolation. Global equities are measured in the hundreds of trillions. The bond market is over 100 trillion. Global real estate is measured in the hundreds of trillions. Gold represents another enormous pool of wealth, and crypto is still a relatively small market by comparison. So the real question isn't whether XRP can somehow pull 6 trillion out of thin air. It's whether the digital asset market itself can expand dramatically and whether XRP can capture a meaningful share of that growth. That's where the math gets interesting. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the market. Thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. Now let's zoom out for a second. The world's financial system isn't measured in trillions of dollars. It's measured in hundreds of trillions. Global real estate is estimated in the hundreds of trillions of dollars. Global bonds represent another enormous pool of capital. Global equities are measured in the hundreds of trillions. Let that sink in. Gold represents another multi-trillion-dollar store of wealth. And then you have cryptocurrency. Compared with these markets, crypto is still relatively small. That doesn't automatically mean crypto will absorb capital from them all. That's where we need to be careful. A larger traditional market does not guarantee money will migrate into XRP. But it does establish something important. There is an enormous global pool of capital that could potentially interact with digital assets. And that's the part of the XRP thesis that often gets lost. The ceiling isn't necessarily today's crypto market. The question is whether blockchain infrastructure can eventually become part of a much larger financial architecture. Here's the 2030 $1 trillion scenario. This is where some institutional forecasts become interesting. Some major financial institutions and asset managers have discussed scenarios in which the broader digital asset market could eventually grow into the tens of trillions of dollars. Let's use a hypothetical range of 20 trillion to 30 trillion. Not because we know that that's going to happen. We don't, but because it gives us a framework. If crypto became a 20 trillion asset class, a 6 trillion XRP market capitalization would represent approximately 30% of the entire market. At 30 trillion, it would represent roughly 20%. That is obviously a very large share. So the argument shouldn't be crypto reaches 30 trillion, therefore XRP automatically reaches $100. That's a bad analysis. What role would XRP have to play inside the 20 to 30 trillion ecosystem? Because market capitalization follows perceived value, demand, liquidity, utility, scarcity, and expectation. And that brings us to XRP's biggest potential advantage: utility. Why market cap is only the start, ladies and gentlemen. See, now, whenever you mention market cap, somebody inevitably says market cap isn't the same thing as money flowing into an asset. And that's absolutely true. This is one of the most important points in the entire discussion. If XRP has a 6 trillion market capitalization, that does not mean 6 trillion of fresh cash had to enter XRP. Market capitalization is calculated by multiplying the price by the relevant supply. It isn't a bank account. It's a valuation metric, and liquidity matters. If relatively little XRP is available for sale at the current price, a comparatively smaller amount of new demand can potentially move the marginal price substantially. But, and this is critical, that does not mean there's a guaranteed 50x or 100x multiplier between capital inflows and market capitalization. Those multipliers depend on market depth, liquidity, holder behavior, leverage, derivatives, market structure, and many other variables. So let's throw away the simplistic version. The correct takeaway is XRP would not necessarily require 6 trillion in literal new cash to print a 6 trillion market capitalization, but it would require enough sustained demand and market repricing to support that valuation. That's a much stronger argument. Let's talk about the rise of equities. And we've seen something similar happen before. See, in the early history of modern stock markets, equities were nowhere near the enormous global asset class they are today. Over decades, financial markets expanded, companies grew, institutional ownership expanded, retirement systems developed, brokerage access improved, regulation evolved. Capital markets became increasingly integrated into everyday economic lifeline. That stock market didn't become $100 trillion ecosystem overnight. It grew alongside the financial system itself. That is a historical lesson. And here's the first important analogy. Crypto today is less like a mature global stock market and more like an emerging financial network still building its infrastructure. That doesn't mean crypto will inevitably reach the same scale. It means we're comparing a relatively young financial system with institutions that have had decades or centuries to mature. Let this sink in. That's massive. That's why looking only at today's crypto market capitalization can be misleading. Here's XRP supply problem. Now we have to address the other side of this equation. Supply. Because you cannot discuss a $100 XRP scenario while ignoring XRP circulating in total supply. There are hundreds of billions of XRP in total supply, while the circulating supply is lower. That means the exact market capitalization associated with $100 depends on which supply figure you're using. If approximately 61 billion XRP circulating, $100 would imply approximately 6.1 trillion in circulating market capitalization. If circulating supply rises, the required market capitalization rises too. This is basic mathematics, and it matters. XRP holders shouldn't pretend supply dynamics don't exist. Ripple also controls a significant amount of XRP through its holdings and escrow arrangements. The company has historically released XRP from escrow according to its established framework, with portions returning to escrow depending on usage. So future supply dynamics are absolutely something investors should monitor. But there's another important distinction. Ripple releasing XRP does not automatically mean every released XRP becomes permanent selling pressure. Some XRP can enter institutional markets, liquidity arrangements, ecosystems, activity, or other uses. The market impact depends on what happens to those tokens after release. That's why the simplistic claim that every monthly release equals an immediate market dump is too broad. The real issue is net supply entering active circulation versus demand absorbing it. The numbers that change everything. But here's where it gets interesting and spicy. A 6 trillion XRP valuation sounds insane if you compare it with today's crypto market. It sounds very different when you compare it with the global financial system. Imagine XRP isn't competing only against Bitcoin, Ethereum, and thousands of other tokens. Imagine blockchain infrastructure is increasingly interacting with payments, stable coins, tokenized securities, institutional settlement, and cross-border liquidity. Now the addressable market becomes much larger. That doesn't prove XRP wins, but it changes the question. Here's the global payments opportunity. See, cross-border payments are enormous. Corporations move trillions of dollars across borders every year. Banks settle international transactions. Remittance companies transfer money between countries. Financial institutions manage liquidity across currencies and jurisdictions. And the existing system is fragmented. Money doesn't physically travel across the world every time a bank makes an international transfer. Instead, banks use correspondent relationships, messaging systems, Nostro and Vostro accounts, liquidity arrangements, clearing systems, and settlement infrastructure. The system works, but can also be expensive and slow. And that is where blockchain technology enters the conversation. A blockchain can potentially operate as a shared settlement layer that functions around the clock. XRP's potential role is particularly interesting because XRP ledger technology was designed around fast settlement and low transaction costs. Transactions can settle in seconds. That is dramatically different from the traditional experience consumers often associate with international transfers. But we need to separate two things here. Technology capability is not the same as global adoption. XRP can technically settle quickly. That doesn't mean every bank in the world will use XRP. Adoption requires regulation, liquidity, integration, management, compliance, interoperability, and commercial incentives. Let's talk about the SWIFT comparison. This is also where the SWIFT comparison needs nuance. SWIFT isn't simply a giant payment processor moving every dollar from one bank to another. It's primarily a global financial messaging network. Actual settlement can happen through separate banking and payment infrastructures. So saying SWIFT takes 3 days and XRP takes 3 seconds oversimplifies the system. But the broader point remains important. Modern finance is increasingly moving towards faster, more transparent, always-on settlement. And blockchain networks are competing to become part of that future. That's the structural trend. Short-term noise, long-term structure. Price can move violently in either direction, but underneath the price, financial infrastructure is changing. Let's talk about the railroad revolution. There's a fascinating historical parallel. During the 19th century, railroads didn't merely create faster transportation. They reorganized entire economies. Cities changed. Supply chains changed. Commodity markets changed. Businesses could reach customers that were previously inaccessible. The infrastructure created new economic possibilities. That's the second historical example. And here's the analogy. Blockchain networks could play a similar infrastructure role for financial value that railroads played for physical goods. Not because blockchain will replace everything, but because infrastructure can become more valuable as more economic activity depends on it. And if XRP were to become a significant liquidity asset inside that infrastructure, the valuation conversation would look very different. See, the tokenization changes the addressable market is a big thing to understand. Now we reach one of the biggest structural arguments, tokenization. The idea isn't simply to put blockchain or XRP on a blockchain. The much larger opportunity potentially putting traditional assets themselves onto blockchain infrastructure. Treasury securities, money market instruments, funds, private credit, real estate, equities, commodities, stablecoins, central bank digital currencies. If even a fraction of the world's financial assets become tokenized, blockchain networks could process an enormous amount of economic activity. Let that sink, that's huge. And that's where the difference between asset valuation and transaction value becomes important. A network doesn't necessarily need to own every dollar moving through it. It needs to provide infrastructure that users actually want. For XRP, the bull case is therefore not simply, will XRP replace all money? That's far too simplistic. The more defensible thesis is, XRP could potentially function as a bridge or liquidity asset with a more interconnected digital financial system. Whether that happens at scale is still an open question. It's institutional capital. Now we come to the biggest missing ingredient, institutions. Because retail investors alone probably cannot transform crypto into a global multi-decade asset class. Institutional participation can. Look at how financial markets evolved. Pension funds, insurance companies, endowments, sovereign wealth funds, banks, asset managers, retirement accounts. These pools of capital are enormous, and when regulated, investment vehicles make an asset easier to access. The potential investor base expands dramatically. This is one reason exchange-traded products matter. They create familiar wrappers. They create regulated access. They fit into existing investment infrastructure. And they allow investors who may never want to manage private keys to gain exposure through traditional financial channels. That doesn't guarantee capital flows into XRP, but it can lower the barriers. Is the regulation the clarity question? And that's why crypto regulation matters so much. See, for years, one of the biggest obstacles has been uncertainty. What exactly is a cryptocurrency? Which assets are securities? Which are commodities? Who regulates exchanges? How should institutions custody digital assets? How should banks interact with blockchain networks? These aren't philosophical questions. They're operational questions. A major financial institution can't simply allocate billions of dollars because a token is popular on social media. It needs legal clarity, compliance frameworks, custody, accounting treatment, risk controls, liquidity, and regulatory permission. That's why legislation such as the proposed Clarity Act is being watched closely by the crypto industry. The exact legislative outcome remains uncertain. So we should separate the signal from the speculation. Regulatory clarity could make institutional participation easier, but clarity does not automatically mean institutional adoption. Prices reacting, systems evolving. That's the distinction. The XRP math. So let's finally put the numbers to life. Suppose approximately 61 billion XRP are circulating. At $10 XRP, approximately 610 billion market capitalization. $25 XRP, approximately 1.53 trillion. $50 XRP, approximately 3.05 trillion. $75 XRP, approximately 4.58 trillion. And $100 XRP, approximately 6.1 trillion. So now I ask yourself, is 6.1 trillion a large number? Absolutely. But is 6.1 trillion impossible in the context of global finance? That's a different question. Gold is worth many trillions. The global equity market is worth hundreds of trillions. The global bond market is worth well over 100 trillion. Real estate is measured in the hundreds of trillions. So the question isn't whether 6 trillion is theoretically imaginable. It clearly is. The question is, what economic role would justify XRP being worth 6 trillion? That's the question every serious XRP analysis should ask. What would have to go right? For a $100 XRP scenario to become plausible, several things would probably need to happen. First, the total digital asset market would likely need to expand dramatically. Second, XRP would need to retain a major position within that ecosystem. Third, institutional participation would need to increase substantially. Fourth, regulatory uncertainty would need to decline. Fifth, XRP ledger adoption would need to grow. Sixth, XRP would need meaningful utility in payments, liquidity, settlement, tokenization, or another large-scale financial use case. And finally, demand for XRP would need to outpace the effective supply entering the market. That's a lot. That's exactly why a $100 should not be treated as a guarantee. Not at all. It's a scenario dependent on multiple structural conditions. So what could go wrong? Now let's flip the argument. Because if we're going to be intellectually honest, we have to talk about the bear case. Crypto may not reach 20 or 30 trillion dollars. Institutions may prefer other networks. Stablecoins may capture a large share of payment activity. Banks may build private settlement systems. Central bank digital currencies may develop independently. XRP may remain important without becoming the dominant global bridge asset. And competition is intense. Ethereum, Solana, stablecoins, traditional payment companies, bank-led blockchain projects, central bank infrastructure, other interoperable protocols. XRP isn't operating in a vacuum. That's why the $100 thesis is not simply a supply story. It's an adoption story. Think about the early internet, ladies and gentlemen. The internet became enormously important, but that didn't mean every company building internet infrastructure became equally valuable. Some technologies won, some disappeared, some became commodities, some became foundational infrastructure. That's the second historical analogy. And that's precisely how we should think about crypto. The existence of blockchain adoption doesn't automatically guarantee XRP adoption. The network has to earn its position. The technology has to solve problems. Institutions have to want it, and the economies have to work. That's the difference between speculation and infrastructure. Here's the bigger picture. So let's return to the original question. Can XRP reach $100? At today's crypto market capitalization, the math is extremely difficult. At a dramatically larger digital asset market capitalization, mathematically it becomes much more conceivable. But mathematics alone doesn't create value. Utility creates demand. Scarcity can amplify demand. Institutional access can expand the buyer's base. Regulatory clarity can remove barriers. Tokenization can increase blockchain activity. And global financial integration can create new use cases. Put all those together, and the potential addressable market becomes much larger than today's 2 trillion crypto market. But none of those outcomes are guaranteed. That is why the strongest XRP thesis isn't XRP going to $100 because somebody on YouTube said so. The stronger thesis is if digital assets become a major component of global financial infrastructure, and if XRP becomes one of the critical liquidity and settlement assets inside that system, then multi-trillion-dollar valuations become mathematically possible. Possible, not guaranteed. Again, not guaranteed. There's a massive difference. Here's the final takeaway. And this is the part I want you to remember. Don't focus exclusively on the $100 number. Focus on the support required to support the number. If crypto stays a small niche asset class, $100 XRP becomes much harder to justify. If blockchain becomes financial infrastructure, if tokenization expands, if institutions enter at scale, if regulatory frameworks mature, if XRP captures meaningful settlement and liquidity demand, then the conversation changes. Because you're no longer comparing XRP against today's crypto market. You're comparing a potential financial infrastructure asset against a global financial system measured in hundreds of trillions of dollars. That's the real thesis. And that's why the $100 XRP conversation deserves something better than hopium. It deserves mathematics. It deserves market structure analysis. And most importantly, it deserves an understanding of how financial systems evolve. Short-term noise, long-term structure. The price can move up. The price can move down. The narrative can change tomorrow. But the infrastructure being built today could shape the financial system for decades. So what do you think? Is a $100 XRP realistically achievable if the digital asset market expands into the tens of trillions? Or would XRP need an unrealistic large share of the market to get there? Let me know your number in the comments. And if you want more deep dives into XRP, institutional adoption, tokenization, crypto regulation, the macro forces reshaping global finance, make sure you like this video, subscribe to the channel, and turn on notifications. Because we're not here to chase hype. We're here to follow the money, understanding the infrastructure, and separate short-term noise from long-term structure. I'll see you in the next video, ladies and gentlemen. Hope everyone's having a blessed afternoon. I want to welcome all the new members of the Crypto Republic Desk Monthly inside the Patreon, all the new members of the membership channel. And yesterday's rant, which was something I tried to put into non-PhD out of PhD words, so you can understand that, to me, my entire thesis is, do you want to give money, or do institutions want to give money to broke governments that are printing money out of thin air for exorbitant amounts of time that's going to yield you back in fiat currency that is losing value every day? Or do you want to have a chance at the blockchain bonanza, as far as we're concerned, that's going on? That's a decision only you can make. I know what I want to do. I know what I tell people that retain myself and organization in any capacity. It's no different than digging things out of the ground. The financial world is changing for many reasons, and you can see this. When you leave the area of just the Harry Houdini freak show, death by 1,000 tweets, you begin to see that the whole world is following the same things. That will take you somewhere in the beginning, but eventually it gets crowded. The narratives will change. The ticker symbols will change. The financial products will change. Ask yourself this. Which one would you rather hold? And I know people are going to say here, I've been holding since this date, up, down, left, right. I hear you. Believe me, I hear you. When you doubt the scenario that we're in, listen to yesterday's video and my rant, even though it was longer. It will tell you the dynamics of why, what people are looking at. The people that institutional adoption rests upon. That's what they're looking at. And they're not going to flood an asset with money until the rules of the road are there. It cannot be the Mad Max Beyond the Thunderdome or the Fury Road. It can't be that. It needs to be a lit runway. Once that runway is lit, baby, XRP, ICP all the way. For me, I believe the chance of the future is more important than the gifts of the old. We can watch the numbers every day that we do. We watched oil. You got a scenario right now. There's no way there's going to be any form of ceasefire. There never was. There will be hostilities to bump up the price of oil. There will be things to push the price of oil down. This is going to affect all markets. The AI trade and all the institutions funding it is what we're watching right now. That is how you don't get caught up like sushi. You learn to survive in the dry season of investing. See, I don't believe. My definition of cycles in the market is very different. We need to be able to make money in a bear market, a down market, a bull market. I don't believe in the terms other people use and say, and that's okay. Doesn't mean I'm right, doesn't mean they're wrong, and vice versa. It just means that my investment thesis and what we follow is very different than what they're doing. It's all about absolute returns in the end. If you want to learn how to trade, and you want to learn how to invest, and you want to learn how to take advantage of everything that we talk about, come and join the Crypto Public Desk Monthly, ladies and gentlemen. Join over 670 active traders who are taking their destiny into their own hands and learning it and understanding the deeper macro research. Our program is very simple to follow. Anybody can use it. I love you all. I'm going to see you on the front lines. None of this is financial advice. This video is for education and entertainment purposes only. Always consult a licensed financial advisor before making any investment decisions. Never invest a single dollar from watching a YouTube video. I love you all, ladies and gentlemen. Don't get cut up like sushi. And I want to see in your comments in the section below. What would you rather put your money in? We went over the central banks from the major areas. You want to lend them money and get nothing back in return from some psychotic long period of time? Or do you want to have a chance? That golden ticket, baby. XRP, 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 ICP, ICP, H bar, H bar, H bar, and XLM if you love XLM. Answer me this and riddle me this, Batman. Where do you want to put your capital? I love you all. See you on the front lines.